There we
Mr.
go.
Ryne Williams coming in on a runner's high. How was the run,
Yeah,
man?
we are. Oh, dude, it was fantastic. I went about 5 miles this morning. I've been getting into running probably this last month and a half or so, or I should say, getting back into running. I was really, really deep into it, like during the pandemic and stuff. All the gyms were shut down, and so really for me the only way to stay active was running, and I got super into it. Then when the gyms opened back up, I kind of fell out of it. But I don't know. This probably about 6 weeks ago, 7 weeks ago now. I got the itch to start running again, and so I've been doing it. A few times a week. I'd say I've been going out 3, 4 times a week, and today I got about 5 miles in. Felt really good, and yeah, I'm definitely feeling those endorphins. So this is a good way to get those out too, put them
To
to
bring
use.
it home.
Yeah. So we were just talking before we went live. We were talking a bit more about this stuff, and Ari was talking about how, and I won't speak for you. I'll let you jump in and finish it, Ari. But he was talking about how he used to be into lifting, not so much anymore. But I mean, what were you saying on that? Because I had a tie into
Yeah.
investing, but I want you to set the stage.
So basically, Ryan came in and I said exactly what I just said, right? Coming off that runner's high. And we started talking about working out. And my truth is that I used to love going to the gym and working out and throwing weights around, and I used to play football the whole 9 yards. And then 7 years ago I got sober and I realized that I didn't really love going to the gym. What I really liked was, I hit workout, get the workout in and get out. And my whole life changed. And these days it's more about, I do about a 15-minute, literally 15 minutes, no more, hit workout in the morning. And then maybe twice a week, 3.5 mile, 5 mile run. And I realized I don't actually love working out. I like to be in shape. And then Ryan got into this conversation of ties into investing. I mean, every investor is different. So I'm going to toss it back to you, man, because you were on fire before I hit record there.
Thanks, man. Yeah, and you guys, if you watch my channel, you'll have heard me say this before. I've written about it before, and you're probably sick of hearing me bring this up and make this comparison, but it's so true. Ari, what I gathered from that is okay, he still thinks this stuff is important to do. It's important to take care of yourself and to be healthy and to be in shape, but you have to find a way of doing it that you enjoy. And in the fitness realm, it can be so many different things. You could be into bodybuilding, you could be into powerlifting, Olympic lifting, CrossFit, basketball, Pilates, calisthenics. There's so many different ways to burn calories, or running or jogging or whatever. So there's so many different ways to, as I say, skin the cat. And there's so many different ways to do it. And the same is true, and none of them are wrong. The moral of the story is you have to find the way that fits you best and is the way that you can adhere to for a long period of time. Because if you don't enjoy it, you're not going to stick with it. So it's important to find, whatever your jam is. And the same is true with investing. There's so many different ways to build wealth. You can buy growth stocks, you can be a day trader, you can invest in crypto, you can do real estate, you can buy precious metals, you could be a dividend investor. It's really the same principle. And the same principles hold true. You've got to invest in the way that best suits you, and that's gonna look different for everybody. So I just thought, I've always found that to be an interesting comparison between the two. And the same is true with investing too. A lot of people, it's not fun. They don't really like doing it. There's a lot of ways you'd probably rather spend your money, but it's important. Investing is important. And kind of this is the last, I'll tie this tangent up right
Man.
here.
Just
I'm
keep
sorry,
going.
Ari. And the thing about both of these is once you start doing them, you do it more so out of just knowing that it's important. You might not be that excited about it, but you should be doing it. But the thing with both of them, and Ari, I don't know, maybe you can speak to this too. Once you get going and once you start, we'll just stick with investing. Once you start building your portfolio and get in the groove and seeing that value go up and seeing those dividend payments getting larger over time, it's this switches, switches or flips.
This is a runner's high.
And
This is what it looks like.
yeah, I know, man. But it's something changes in you is what I'm trying to say. And you start to enjoy it, and it starts to click. And then it starts to become a lot of fun. And you kind of shift from doing it because you know you have to do it to doing it because you actually enjoy doing it. So,
But, dude, I mean, it's, when I hear that from you, I mean, my journey makes sense, right? It's my story, it's my journey. But it's also funny because what I'm big on these days, as you know, is like understand your investor profile, like really define yourself. Who are you? And so, yeah, I still love, the endorphins, right? The running and the 15 minutes in the morning. I love it all. But what I've discovered, through a journey of like deeply going inward is that I don't love the gym. I don't want to be there for an hour. For me, I'm never going to need to pick up a fridge by myself over my head, right? So I was like, why do I need to move all this weight? And these days, I mean, I love, more of the tea and meditation, stretches, 15 minutes in the morning, that HIIT workout. And it's exactly how I came to be in terms of my investing journey, because I thought I was X, and it turns out that after a little bit of discovery, I'm actually more Y, right? Or more so, I should be more Y based on where I want to go. Like, it's all just to tie in that, like, as an investor, the most important thing that you can do is find yourself. As a person, the most important thing that you could do is discover yourself. And I honestly don't think enough investors spend time in this kind of reflective period to say, like, what am I doing? What is my goal? It's so easy to jump online. I mean, like David Goggins and all these guys, man, you jump on, you're like, oh, I want to be ripped, right? Or these NFL, I want to be big. I used to be a gym trainer as well. And it's just funny, you ask people, they come in, they're like, I want to get ripped. It's like, what does that mean? Like, just like define that, right? You start talking about investing. I want to make a lot of money. What does that mean? I want to be this investor. What does that mean? Like, what are your goals? Where are you looking to go? And more importantly, if you're looking to get to X, like, there's a certain track for that. And everybody's going to have a different track. And so therefore, I guess, I'll end my rant with this. Like, I think we got to end all the hate, in the comments and everything when investors are sharing their journey and we're like, that's the wrong way. Is it? I don't think it is. I think it's just someone else's journey. Like, respect it.
Dude, I'm so glad you brought that up. And I think that everything we just discussed, I think, is going to be a really common theme in these conversations. It kind of ties into some of the stuff that we've talked about in the previous 2 times we've gotten together. This is now episode 3, which is awesome. I'm stoked that we're doing this still. I hope you guys have been enjoying this too, all of you watching and listening. But I'm so glad that you brought that up, man, because those people, I mean, they may be right. We may be wrong. We may be right. We may be wrong. But I don't know. Maybe it's not so much about being right or wrong, because kind of like we've discussed, there's more than one way to skin the cat. Sure, Bitcoin, like, we would have probably made more money this year investing in Bitcoin at the start of the year or a couple months ago. Okay, but and that's gonna work fine for some people. That doesn't really fit my investor profile or my temperament or all of the different things that make up that profile. That's just not really my cup of tea. For other people, it works great. And it's the same with like owning rental properties. It's like, yeah, but you could have this, or you don't have to worry about that when it comes to rental properties, or you get the depreciation. And it's like, yeah, I get it. There's pros and cons to everything. And at certain points of time, some things are going to perform better than others. And still, there will be times, I mean, dividend investing, buying dividend stocks or dividend paying stocks has really been like, it's certainly received its fair share of criticism. I would say since both of us like started at least creating content on here, probably it started before that, but yeah, dividend investing has certainly received its fair share of criticism and pushback. And it's kind of like the ugly stepchild of the investing world. But, I think it's possible there may come a time where people won't think of it that way, and they'll have a different opinion. And I think it just kind of goes back to, and what determines that, and like what's in style at the time, what's the flavor of the year, I guess, in terms of investing. It could be Bitcoin, it could be Nvidia, could be Palantir and SoFi. And dividend investing will probably have its time again in the spotlight, and it'll just, depending on where the market cycle's at and what's going on, it'll shift. And so that's, I think, even more of a reason to find the way that works best for you. So you're not constantly dancing around to all these different things. It's good to have like a defined approach that fits your profile and fits your temperament. And, like we've established, that's going to look different for everyone. So, the hate's unnecessary. You could be right. There's times where you'll be right. There's times where you'll be wrong about what performs better or worse. And, it's a constantly ongoing thing. It's something that never ends. So, who's to say who wins and loses the game when the game is constantly being played? It's still, we're in the second quarter, so to speak.
There's another YouTuber who's out there, and I was once talking to him, and he goes, at the end of the day, it's all about the scoreboard, and the scoreboard is your personal brokerage, and as long as you're up, you're up. And I think that's just another aspect of this is it's like some of us also may have to get our feet wet, just like with a standard, broad market ETF, just so you can see that, over the course of the year, you made some money. And then you might get a little bit more comfortable and start investing in individual stocks. Maybe you won't. But at the end of the day, Warren Buffett's rules are what I go by. Rule number 1, don't lose money. And rule number 2, follow rule number 1. As long as you're doing that, I think we should be applauding everybody's efforts. And it was interesting you shared, maybe it will be like a trend comeback, right? Like dividend investing comeback. I think every investor comes around eventually to understanding dividend stocks and the important role that they ultimately play if you're building a portfolio for yourself and you're not just investing in ETFs. Like there's a time and a place for it. And I definitely think if you're new to the market or you're young, it's the time to go more into the growth deep end. And as you really learn, like, okay, you get to trial and error with it. Can you sit well in volatility? Like, can you sit well when Palantir plummets, I don't know, by 20%? And then you could see another guy, like a dividend investor, who's just skating on by all the volatility, like not even sweating. I think it comes down to that as well,
100%, man. And in terms of developing your investor profile and knowing like ultimately what's going to be the best way to structure your portfolio, like in what's the best fit for you, it's something that comes with time. I don't know if you felt this, but I feel like really these last couple of years I've noticed myself like coming more and more into myself as an investor. I'm really having a better idea of what I like in a company, what types of companies I like to invest in, what I understand, what I really don't understand. And I think a lot of those things just come with time. And when you first start out with investing, we can, like for people in our position who put out videos like this and just put out so much content around investing and talk about different stocks and different videos, it gives people ideas. And some of those people are going to be brand new investors who watch these videos and think because we're talking about it that means it's a good buy, or that they should buy it just based on what we say about it, which is obviously not, you got to do a bit more homework there. But anyway, there's going to be so many new investors where that's the case, who maybe don't know exactly what to look for yet, or don't even know to think about what their investor profile might be. And so they just model what seems to be working for the people that they're watching. And I think that's like a really natural way to get into this. And I think, in hindsight, thinking back to when I first started investing, I went all in on, individual companies. I didn't start with ETFs like I should have. But that was exactly it. I was watching people here on YouTube, just seeing what they owned, seeing which stocks they bought. And that was kind of like my basis for investing at the start. And, in hindsight, obviously that wasn't the right way to go about it. But, it still got me it still got me in, it still got me investing. So I think that overall it was a net positive. And you start, I think a lot of people tend to start with that. And then the more you start to learn some of the basics, you can start picking off maybe some of the companies that are ones that you should invest in. You'll start to realize those. And then maybe at that point, you'll start to develop your investor profile, and you'll start to think, hey, this stock picking stuff is really not for me. I should go more into ETFs. Or it's the other way. It's like, hey, this company isn't good for reasons X, Y, and Z, but I'm starting to understand what makes for a good investment. So let me try actually doing the right thing in individual stock investing, and likely people will take a hybrid approach between the two. But all of this is to say, like, it's natural for people getting into this to just model what seems to be working and go from there. And as much as we can advise against that and just say, guys, just if you're brand new, just start with ETFs. Just dip your toe in the pool before diving right in. Just get your feet wet with it and then kind of build it from there. It's easy for us to say that, but still, I think it's a net positive if people are just investing it all, and they'll figure it out. Hopefully, they just don't put $50K into TSLY right off the bat. You know what I mean?
Probably any comments about that comment.
And that's not. I don't say that to criticize or be disparaging. I really don't, because that's just another example.
Like 50 comments coming in, like, "Hey, that's my entire portfolio."
Well, that's just another example of like there being more than one way to skin the cat. Look, I no judgment for anyone who holds those. Like, seriously, it's, you got to do what you think is best. It's not my cup of tea. It's the risk that comes with those is not something that I want to take on. You may feel differently, and I hope that it ends up being great for you. Like, and I hope I end up being wrong about it. I sincerely do.
You know what's amazing to me, and I know today, like, we should run through some of these comments that we've already gotten on the first two episodes, but I've been reading through them, and I was also just doing another Masters of the Market call the other day, and an amazing Master of the Market coming up. I'm super stoked. This girl that I interviewed. First of all, I'll get to this, and then I'll go back to what I was saying. She moves to America from Africa, goes to college, $120,000 in debt. In 14 months, pays off the debt, and then gets scammed $30,000, overcomes that as well, and she's sitting on north of $500,000.
Yeah.
What? But the reason I bring her up is actually not because of any of that. The reason I bring her up is because in the interview, she shares, Ryne, how me and you were what initially prompted her to jump into the market. And I've seen so many comments out there that have said, like, wow, my two favorite, dividend investors or YouTubers, or these two guys, are the first two that helped me out. And first of all, I just want to say thank you to everyone out there, because Ryne and I are just sharing our journeys here, and it's really all of you, the community, that keeps us going. And so I'll say thank you for that. But what's just incredible is just by sharing our journey, just by us getting started and then showing other people that's how you do it. Just that spark that turns into a flame. And over time, you learn your investor profile, and you make the mistakes, and you do the whole deal. But just start, and that's all it really takes. And then you never really know at the end of the day. Like, you may start a portfolio, you as in the viewer, and then, I don't know, maybe your son or your daughter or your friend or whoever else is looking at you saying, well, I want to start too. And then you're impacting the world. I mean, it's just amazing when I think about it on that end. And I don't really think there are such things as mistakes here. Even a loss in money, right, is the good old tuition bill kicking in from the University of Hard Knocks. So can we really say we're losing?
Yeah, I mean, it's a fair price to pay. Fair price to pay. And you're so right, man. I mean, the best part about doing this, is getting messages like that and hearing people's stories, because just making that decision for this gal, and I know who you're talking about. She's a rock star, and it inspires us too. Like, that's insane, and makes me want to just push it even harder and keep going, because it just shows that, like, no matter this, we are so fortunate to live in this day and age where investing is so accessible. It doesn't matter what situation you're in, where you come from, like how much disposable income you have left over. Even if you have $1, you can start. And the barriers to entry to get into this are just so low. And hearing people's stories and hearing what they're able to do just with what they have is so crazy sometimes. You just never know what that stuff can grow into. And I think, like, if there's if there's any takeaway, at least from, I can't speak for Ari, but like for my channel, the main thing that I want people to take away is that literally anyone can do this. If I can not in my portfolios, I haven't even hit $100,000 yet. It'll happen soon, but if I can come into this a blank slate, not knowing anything about this stuff, and find some success in building a portfolio and share that, if the key takeaway is like, if Ryne can do it, then anyone can do it, then like that's all I want. The main mission with all of this is just to spread it and just to get everyone doing this, because it can make such a big difference in your life. And it's something that everyone's going to have to do. As Warren Buffett said, that classic quote, if you don't find a way to make money in your sleep, you're going to work until you die. And the only way to get people more into it is just by talking more about it. And so the more people that are talking about it and, sharing their portfolios and sharing their stories, that's what's going to really move the needle and get more and more people involved. And we're seeing it head in that direction. And when I think about this gal, Ari, and I'm so excited for that conversation because she is a rock star. Like I said, it's just so inspiring she did it in just a few years too, which is crazy.
4 years.
Yeah.
Like
crazy.
And, like I just can't, an immigrant to the States, like no one has, and she harped on this. Like I was trying to contain my excitement on this end because her story is just, it's powerful. I mean, it really, and I even asked her, I said, what do you think it is in the United States? And maybe it's probably not just in the United States, but it's like, why we all don't have this tenacity, this fire, right? To get started and to move. Like when you realize that life is totally in your hands, the moment you decide to take total responsibility and become the CEO of your own life, and there's no more excuses, like no one's going to come and save you. So what are you going to build? What are you going to do here in your short, less than 100 years? And what's crazy is like, we can go all we want, because I always, I never learned this in school. It's like, okay, but there's books. Okay, but now we live in the age of YouTube and podcasts and anything else you can get your hands on. I mean, there's no excuses. And yet somehow people still find themselves digging up some excuses. I don't, for the life of me, I don't understand. Like, the knowledge is there. And like you said, it's like $1 a day. With fractional shares today, people, what's going on? If I can scrounge up, and I harp on people who, I know you go to Starbucks, so I won't bash it too hard, man. I know you get the black coffees there. But if people are going to Starbucks every single day, and I always joke, I always say like a mocha, choca, froca, whatever latte thing, right? I'm more of the Graham Stefan, make your coffee at home and keep it that way guy. But I think if that's your habit, like, do you even enjoy coffee, or are you just going because that was a kind of like habitually built into your day? Like, are we really understanding what we're doing, and when do we stop blaming school and upbringing and parent? Like, all the information is there.
Yeah, it's so interesting, man. I probably think about it more than I should, but people's spending habits and the way that they spend money is always so perplexing to me. I don't know. And I think investing to the extent that we do, and I think this applies to all of us here in the community, you guys watching, I think we can all agree with this. Like, investing and enjoying investing is such a huge hack for just like not spending money outside of your portfolio, or like really being smart with it. And it's not because you feel like you need to pinch pennies. It's just because like you enjoy this so much that you want to do more of this, that you kind of start to lose interest. Like naturally the interest for some of these other things like just starts to fall off. I love Starbucks, but I don't go every day. I maybe go once or twice a month at most, really. It's a treat. But there are, like you said, there are some people who habitually go every day, which is, from an investor standpoint, it's like those are the things I think about. But yeah, once you get more into this stuff, like let's say you are a habitual Starbucks goer, I bet if you start investing and start seeing results in your portfolio, you'll want to go to Starbucks less, or you'll want to, you'll want to go maybe eat out less often. Instead of going to Javier's, you'll go to Chipotle. Yeah, Vegas reference, Vegas
I
restaurant.
don't even know
reference,
Javier's. Am I missing something?
it's just like a nice Mexican restaurant on the strip. But you'll naturally just want to be more frugal, and it's not because you feel forced to. It's just because, like, your perspective changes, I think, on what's important. You start to realize that more than anything, like, having control over your time is way, way more important than, like, buying a new pair of jeans, even though they are 60% off, or buying this, that, or whatever. So anyway, I think investing can be a really powerful thing. Not only just, you can start building wealth, but I just think it helps realign with your perspectives with what's really important. Because like you said, like we only have one go around at this, and we spend so much time like working and having other people control our schedules and times and where we're going to be and how long we're going to be there. And that's just life. Like that's a part of life. But if you can get out of that and buy back control over your time, as fast as you can and start taking steps towards that, then I think that's just such a worthy cause. And I don't know, I'm kind of losing my train of thought, but and that's not to say like work is bad. This is what I wanted to get to. That's not to say that work is bad, but it's like having control over your time and being able to focus on just the things that you enjoy is better than anything else. And one thing that I think really helps frame this perspective is this book right here. A lot of you guys probably will have already read it. Ari, I know you've read it.
Classic.
Psychology of Money. I think like if you want to get someone interested in investing, and it's hard to get people into reading too, like that's a whole nother can of worms.
That's a whole nother podcast,
yeah.
man.
But if they're open to it, if you have someone with an open mind, give them a copy of this book. I think it'll really help get them started on the right foot.
It was funny. So I sat with someone earlier today, and he's an iron worker, and he was like, I never got into this whole investing thing. I always wanted to, and he goes, how do I start? And I'm like, man, it's so easy. And I said, first of all, like, what are you currently doing? Like, what give me some of your habits. Like, what are you doing in the day? Like, how are you living? And he's explaining his day to day. And he's like, I eat out, basically for lunch and dinner because I'm just, I'm on the go and whatever. And I go, man, I want you to try just 2 days this upcoming week. Just 2 days. Don't go out. Just pack your lunch, right, or eat in, and then take that money, and we're going to open up a Robinhood account for you. It's this simple. And we're going to take that money, and we're just going to throw it into the S&P, right? That's it. And keep it that simple. And then he goes, well, what about like these individual stocks, like investing in a company? Because I see your videos, and yeah, it's even simpler. I go, you're an iron worker, so name some of the tools that you're using. And long story short, we get to Caterpillar. And I'm like, are they good tools? He's like, they're amazing tools. And I'm like, so you would never diverge from using Caterpillar's tools, right? And he goes, no, I love them. I love Caterpillar tools. And I go, well, congratulations. That's how you pick your first individual stock. Like, do you believe in that company? And it really is that simple. And then, not only that, like we were just talking about this a little earlier, but to kind of tie it in, I heard this one before, you can go your whole life on this rat race and run as fast as you can, but at the end of the day, at the end of the race, Ryne, you're still a rat. And so to me, I think about it and I'm like, and I always say get rich by Tuesday, right? You don't want to try to get rich by Tuesday. And you could do this thing the right way. You could build a really solid portfolio. And at the end of the day, and knowing that I'm still just a rat, right? I want to make sure I do it the right way. Strategically, not losing money, not taking these massive risks just because I see, the excitement that everybody else has emotionally investing. And again, like someone else commented too, like about Buffett. on one of my videos, and this is just coming to mind now. Of course, Buffett's making all the dividends now. And I'm like, but it also wasn't that way for Buffett earlier on. Like, Buffett just focused on good companies. That was it. Some of them paid dividends, sure, but some of them did not pay dividends. At the end of the day, this guy is going for high-quality stocks. That's it. That's what he's doing. Good businesses. And just staying in them for the long term. Not in the rat race. I would say Buffett is the farthest thing from the rat race and our wealthiest, example of the power of just high-quality companies, dividends over time, compounding effect, and enjoy the journey.
Wow, man. Yeah, I mean, that really, I can't really add anything more to that. Just timeless principles. It's not complicated, but it's not easy either. So, because I think part of this conversation, one thing I was thinking about as you were talking is, man, how do people hear all of this stuff? And maybe just your Buffett explanation kind of, fixes that a little bit. But how do people hear us talking about, man, you should invest and try and reach financial freedom as fast as possible and get control of your time? How do people hear that stuff and not think, okay, I need to buy the highest yielding stocks possible? Highest yielders means more cash flow, means faster financial freedom. How do people not, because that's not the interpretation, that's not how we want people to interpret it per se, but how do people not have that as the takeaway from this?
That's why rather recently, a lot of my videos are literally geared towards this investor profile notion, and I keep driving it home. But I just don't think people are really taking the moment to reflect and like really understand themselves as an investor, where they need to go, what they need to be doing. And that's exactly why I started creating these videos more and more, because I want people to understand it's not the instantaneous gratification, get rich by Tuesday, money now, right? Passive income now is better. That's not the case. That's certainly not the case. And if you look to any of the Wall Street sages, they all say the same thing. No, none of them are going, oh yeah, I go for the highest yielding dividend stocks. No, they're like, I go for the highest quality stocks, the highest quality companies that are going to be around and continue to deliver a strong ROI for them. I think we're just, again, we get, I feel like we get stuck in a system. It's the big scam, if you will, right? It's like Robin Hood coming out with their confetti and fireworks when they first came out with the app, and they got big trouble for this. But they get the investor, the retail investor, on the loop. And if you think about this, I used to work in marketing and sales, and this was the whole deal. It's like, how do we get consumers to just get on the hamster wheel, right? Stay on the wheel.
Meaning like make more frequent turnover, more frequent trading. Is that what you're getting to?
Yeah. Hit that buy button as much as possible, right?
So you can get the confetti.
And if you get the dividends and this and that, we don't care what you buy, just buy. And so if it's passive income, you got to think about all this stuff, right? Like the trends. Who are really the trend setters? People think, right? Oh yeah, like this is the new trend. No, this has already been in formation. Like I know, I can tell you definitively right now, I've spoken to people. This is going to sound crazy to you, but it's out there and it's being created right now. A daily dividend income ETF.
Doesn't surprise me.
I know a company that is working on it right now. And I'm like,
what
are we doing?
It doesn't surprise me, man. We obviously have seen monthly dividend paying stocks, shout out Realty Income. We've seen monthly ETFs. We've seen weekly ETFs. Just got a comment about one or a couple of them today, actually. And so, yeah, it just doesn't surprise me that now there's daily ETFs. Or daily dividend ETFs. And that's like
dividend dopamine.
That is, it's such a red flag to me. Like it's so clear that
they're feeding off of us.
It's exactly. People, and that's a huge misconception about like dividends, by the way, like monthly dividend payments. For example, Realty Income paying a monthly dividend versus them paying a quarterly dividend, it would make no difference. Like the payment frequency really in the grand scheme of things, you can crunch the numbers, go on like the marketbeat.com dividend calculator. All else being equal, just change the payment frequency from quarterly to monthly or annually. It's negligible. It's really no difference. But we have this in our, I don't know, there's just something in our wiring that wants those payments more frequently. And it feels like things are happening faster, I think, when you get those more frequent payments. I just did a portfolio review video last week, I think, and one of the individuals whose portfolio I was reviewing said in his notes that basically like, yeah, I know I have a lot of stocks, but I like getting a couple of different dividend payments per week, which suggests like he only owns, and he had like 32, I think, different individual
was this
stocks.
The police officer?
Yeah.
I watched
it was.
that one.
Okay.
Great video, man. That was
thank
an
you.
epic review.
Thanks, man. Those are a lot of fun to put together. I really enjoy making those videos and seeing all of your guys' portfolios. But yeah, I mean, case in point, like he craved those frequent payments. Like in his mind, there was something. There was something better about getting those payments, 2-3 times a week than it would be getting the same amount in dollars once a month. You know what I'm saying? And so, yeah, there's something about that's just part of our wiring. And these fund creators, these companies that make these investment products, which is what they are. They're investment products. SCHD is an investment product. VU is an investment product, but they're different. But when it comes to these investment products, whether it's the 80% yielding ETFs or the weekly dividend paying ETFs or the soon to be daily dividend paying ETFs, like they're playing to your emotions and trying and using that as like a marketing gimmick to get you to buy these products. And I think, Ari, you were saying this last week, or maybe you were saying this in just a different video that I saw of yours, but you said something that like a lot of these people who work on Wall Street and make these products, like you ask them what they buy and they just say VU or the S&P 500. Oh, I just buy the S&P 500. It's like they don't even eat their own cooking. And that right there should be a huge red flag. You know what I'm saying? And also a lot of these ETFs that we're seeing, a lot of these investment products that we're seeing, they come and go. They're here today. They're gone tomorrow. They might be around for a year or a couple years or a few years, but before you know it, like suddenly they're gone.
That's what I'm saying about these trends, man. Like
Yeah.
we're here like, oh yeah, this is the next big best thing. It's like, is it really though? Like, or are you just excited to receive? It sounds like a drug dealer. If I took out dividends and just put drugs, everything that you said is exactly on point, right?
Yeah.
Like they're just playing off of our emotions, and we keep buying into them. Literally, it's dividend dopamine.
Dude, exactly. It's a high that you're
dividend fix.
Exactly. It's a high that you're chasing. And there are people, these companies will come along and try and up the ante, which makes you think, especially if you don't understand your own investment profile or what you particularly, want to see in an investment, like you're always going to be trying to chase that next thing. And there will always be something that comes along and it's going to create high turnover in your portfolio. And it also creates, like, I think, low conviction in the things that you do own. You'll be quick to jump from JEPI or JEPQ into TSOY or CONY, and you'll be quick to maybe jump from that. Like if there was something with a 5% higher yield, you'd maybe jump into that, sell out a TSOY and jump into this higher thing. And I don't know, I just don't think that's a great long-term approach. And that's kind of why, man, I've really just stayed away from and gotten out of and stayed away from covered call ETFs and investment products, with the exception of like the really straightforward low cost ones like VU and SCHD. Like not all investment products are bad. A lot of them are, but the straightforward ones I think are still fine. But that's why I've like really like sworn off of these covered call ETFs. It's just because like there's always going to be something else that comes behind it. And I get questions all the time. Like, what do you think about this fund? What do you think about that fund? And 9 times out of 10, like I haven't even heard of them just because I can't keep up anymore. There's new ones coming out every day. And at what point it's like, after a certain point, it's like they're kind of just all the same, really. Like I can't really distinguish between them. And so now I've kind of sworn off of them. I'm like, let me just buy individual companies and straightforward ETFs. Like for me, it's like, I understand that like it's going to be more tried and true. The S&P 500, SCHD, the principles behind those resonates with me with a lot more than, I don't know, whatever methodology like, synthetic covered call ETFs use. I don't know. It's just,
it's funny, man, when you search, or even in comments, right? Like you just said, like people leave a comment. They're like, can you let us know what the best ETFs are? I feel like they're just waiting for us to mention an ETF in their portfolio to kind of checkbox them that they did the right thing. But it always comes right back to SCHD, VYM, VOO. It's like your standard. And people they click on these videos like we're going to say something else, Yeah. Like and I also think like, and this is not to harp on other creators sometimes, but like if you have creators who are pumping up certain ETFs just because that is the trend, I get nervous when I see stuff like that. Because I'm like, at what point, like we kind of, if you think about it, Ryne, have some real fiduciary responsibilities here. And yeah, we can say all we want, not financial advice, but like people at the end of the day are making some investment moves based on what we're saying. And so I try to be so careful, and especially knowing, if you watch some of these masters of the market videos that I've done with some Wall Street guys, I press them and I'm like, okay, but so what do you invest into? And, they're like, well, just the S&P. And I'm like, okay, but if I gave you $10,000, what would you invest into? Well, the S&P. And they make it sound like it's obvious. And I'm like, again, like what you said, right? You're not eating what you're cooking. It doesn't make any sense here. But yet all of us are like, oh, this is great. A new covered call ETF that's going to pay me every single hour or every single day,
Yeah, and it's... I think the saddest part about this, and I have to shout out Adam Kahn, aka the Rational Investor, really nice guy, Vegas local. We got to meet up at Juan's Flamin' Fajitas earlier this year, and we're overdue jealous. For. Yeah, well, when you come out here, man, we'll all go. We'll all go. But I was watching one of his videos last night, and he was talking about some of these types of funds, and man, he said something that just really. I hadn't thought about it before, but it really resonated with me. He said that the saddest part about it is like those type of funds target retirees. There are a lot of people who are leaving their jobs and relying on their passive income to keep the roof over their head. They're at that stage of life, which is awesome. Like that's what we're all trying to work toward. But it's like these companies are kind of preying on those types of people and get them to invest in these super risky, super speculative, probably like not going to be around for a long period of time funds. And I don't know, it just seems like all signs point to the rug at some point being swept up from under these people. And it's the saddest when it impacts retirees, people who rely on this actually to live. And I don't know. And I don't know. That's another reason that I heard that. And that's just like another reason why those type of things just leave such a bad taste in my mouth.
It's worth going back to the point of conception. Like, okay, so when these ETFs were created and by what companies, I think that's important too. And I think, like, I'm a huge Vanguard fan. I have a Vanguard brokerage account. My money's with Vanguard. I stick to Vanguard ETFs primarily. And I go back to what Vanguard's original MO was with Bogle, right? And it's like he wanted to create something for the retail investor with the cheapest possible fees. Obviously, you're going to have to pay a company at some point in time, so you can't avoid fees entirely. Maybe one day we will be, who knows? But then it's too good to be true, and watch out for it. Anyways, we go back to the low fees, right? Like you said, like VOO, SCHD. They're at, I think, both of them are at 0.06%, if I'm not mistaken. Might be even less than that now. Maybe
VOO might be 0.03. I don't remember. SCHD is 0.06. VOO might be the same, or it might be 0.03. I don't remember.
So nominal. Yeah. And then you go to these other funds, and all of a sudden it's above 1%. Like you're looking at these fees. It's like, who's really in this, right, for the ultimate cash cow? I think the investor, the retail investor, is just being deceived. And then I get the good comments that are like, you just don't know about option ETFs, man. Like, you got it. This is the next big thing. And I always wonder where these people are in the next 6 months or the next year. Because my portfolio, again, I'm happy. I'm not sweating it out. My portfolio keeps going up. I'm enjoying the ride. And I never see these comments from these people ever again. You know, like a one and done. And they're never back saying where they're at with their returns. And then I'll always look too. I'll keep tabs on some of these ETFs. Where are they?
Yeah.
Depreciated.
Yeah, and this kind of, man, I think this kind of just goes back to like what we started off this conversation by saying, or by talking about. In saying everything that we just said, we're obviously coming across like very critical of these funds and whatnot. But at the same time, like I would never personally, I don't want to discourage people from doing what they think is best. Like if they think that that's going to be the best move for their portfolio, that's fine. Like it's because I could be wrong about them. And, the whole point is like, that's just not everything that we've just said is to say that that's just not our cup of tea. That doesn't really fit what we're interested in. Doesn't really fit our temperament. Doesn't really fit like what we think makes for a good investment. If you feel differently, then like rock on, like do your thing. And I also think
drop a comment down there to let us know, like in depth, like no harm, no foul, no hate, no judgments. Drop a comment, prove us wrong, because we totally might be wrong.
100%. And all of this is to say, everything we've just said is trying to like outline some of the reasons why we don't want to put our money into those things. But it's not like a criticism of anyone who thinks that they're good. It's just, we just apparently have a different opinion about it. And, like we talked about last week, like that's going to be true with every company. People are going to be buying shares of Starbucks today. Those people who are buying the shares are buying it from someone who's selling it. Whoever's buying it thinks it's got a bright future. Whoever's selling it thinks its best days are behind it. So it's like, there's that, you'll get that no matter what type of security it is. That's just the nature of it. And, this is just where it goes back to, you got to find the way that best suits you. But yeah, like Ari said, guys, if you have any thoughts on this stuff, drop it in the comments for sure. We love getting comments from you guys, and we want to take some today in this conversation. And I think we'll probably start doing that. Just take some of your guys' questions.
I got some pulled up right here.
Perfect,
man.
Perfect.
And it's right actually on the topic of ETFs. So
Awesome.
I'm going to put you on the hot seat here, Ryne. I got a comment. I won't read who posted. I don't know if we want to do that or whatever. I'm just going to read the comment. Okay. So it says, I don't understand why you guys just don't buy ETFs. My portfolio is 8 ETFs. I think it is a joke buying individual stocks, especially when there are good weekly paying ETFs like QDTE, and he names a couple more, and throw in YMAX, plus all the monthly payers like JEPQ, SPYI, and FEPI. I just added SCHD back to it after a couple of years, so there's no point in having any individual stocks, and all of those I just named are affordable for everyone. I make $1,000 a month for holding them.
Yeah, so clearly that, just from that comment, you can tell what that individual finds important in an investment. It's probably the yield, it's the payment frequency, and there's probably, and these seem to all, with the exception of SCHD, be covered call ETFs, or there's some sort of derivatives involved in the strategy, which I hope they understand them. I hope they can look at the strategy and, be able to understand exactly what it all means. Maybe I can't, and that's why I stay away from them too. But so I guess the question is, why would we invest in individual stocks when there's all these great ETFs like QDTE and TSOY and stuff out there? I mean, we've beat, talking more about these funds would be beating a dead horse. We could talk about it for 3 hours and just go in circles about it. But just like the crux of the question, why invest in individual stocks at all? Man, I just think it's enjoyable, It would obviously be much easier just to buy ETFs. It would be so much easier just to go 100% in VT or VTI or VU, or just like in my Roth IRA, I've split between SCHD and VU. Like, it would be so much simpler and save so much time just to do that, right? And that's great. Like, that's, some people, that's perfect. And actually for anyone, that's not a bad way to go. You'll certainly build wealth by taking that approach, and that's going to be great. But for some of us crazy individuals, like there's just something about this that makes you want to get a bit deeper in the weeds, you know? There's something about thinking about these companies, like what makes Starbucks tick? Why is Target a good investment? What makes Williams-Sonoma, who's up like 25% just today, by the way, what makes that a potentially good investment? Like there's just something inside us that makes us want to go deeper with these companies. And it becomes a sort of hobby. Like, yeah, it takes time to do it, but like the time is worth it because it's fun. You know what I'm saying? Like, and everyone's got their own hobbies. Some people like knitting, some people like investing in stocks, some people like fishing. You know, why would you go out and go fishing when you can just go to the grocery store and buy one? It's already cut up for you. Well, you know, you enjoy the process of it. And the same is true when it comes to investing or anything else, any hobby that you can like really get deep in the weeds with. Watch collecting's another one. Same idea. You know what I'm trying to say. So as though, you know, it's just there's an interest there. And it's fun to be able to like custom build your portfolio and put your money into the holdings that you think are going to be the best of the bunch. And in a sense, you know, your portfolio and the individual stocks that comprises it is kind of a reflection of the way that you view the world. And it's kind of an extension of that. We know what you think is going to happen, what you think about people and how they think and how people are wired, and how they all come together in the market too, by the way, because the market, like when it comes to share prices and all this crazy volatility that we see from time to time, like that, a lot of that's driven by human behavior. So there's just something about that is so interesting to some of us. And that makes us want to go beyond just, you know, the simple, easy, hands-off approach to investing. And it's not for everyone, and it might not be for you. And kind of like Ari was saying earlier, that's a really important thing to come to understand about yourself. And I hope that what you're doing ends up working great for you, and I hope that it builds you a lot of wealth. And you know, the same for me as well. I think we're both going to end up in the same spot, and we can get there different ways. There's nothing wrong with that at all. But Ari, I'm going to kick it back to you.
First of all, I think you hit the nail on the head. I'm thinking about this guy knitting as he's watching this right now. You know, just like this is why I invest in ETFs. Yeah. But no, I think you perfectly stated it. It's like there is something more to this. And it's an interest. It's like that's like telling Buffett, why don't you just invest? Like we know the S&P is there, just invest in the S&P. He's telling all of us to do it, but he's probably not invested in the S&P, and that's probably because he really enjoys taking part in the business, understanding the business, and that in of itself is really fun for me actually, especially when it's a company that their products are something that you use, or if it's something like, I don't know, I'm thinking about Lockheed Martin in my portfolio. I'm definitely not using their products, but I'm like, wow, like this is a really cool company, right? Like I would love to be a part of this team. And like you said, what makes them tick? And the other thing is, I mean, I almost feel like this one is the obvious answer, but like you got to have, you know, something to compare your positions to, right? Like, so are you outbeating the S&P? And if you are with those ETFs, then more power to you. But I know that my Google, you know, position outbeat the S&P. So if that's my goal, I want to try to the best that I can to outbeat it. And I think I can do it, not with every stock, no way. But we can look, you know, the Mag 7s, right? Like just pick any one of them, and they performed phenomenally well. Now, I don't want to say just pick any one of them and invest into them. Pick the stocks and the companies that you have an interest or desire in owning. And that's really what investing is. Again, like this investing can sound so confusing to someone who's just stepping into the arena, because we have the day traders who are out there, and people make this kind of out to be that get rich by Tuesday, you know, quick buy, sell game. And it's real investing is long term. Let me buy this thing. Let me be a part of it. Let me understand their balance sheet, their management team, their products. Like, I want to thrive with the company. I'm happy when I see things in the news that are relatable to my holdings. And then I'm drawn into reading about the what's, whys, and who's behind it all. And if I wanted to, like Ryne said, knit or I don't know, fish, go to the gym, like whatever, then be a passive investor. And more power to you. More power to you, because at the end of the day, we're on the same journey.
Yeah, I mean, everyone's got their thing at the end of the day, and this is ours. It's not for everyone. You have, I'm sure, whoever that individual is, they've got, hobbies. Maybe they like working on cars or motorcycles or something like that. And we might look at that and be like, how can you do that? Like, why would you spend time like with a wrench and grease in the garage where it's cold and just tinkering? So it's like everyone's
super angry at this guy.
I think you might be a closet knitter. You really stuck on that.
I'm actually responding to him now, saying we're answering your question on episode
cool.
3. I feel like it's like do justice.
And I hope he watches this and sees the response, and it's cool. And it's cool to get those different perspectives as well. So, it may sound like a joke to some, and yeah, I get it. Like, I understand it's not for everyone, but I think that's just what we have to boil it down to. It's not for everyone. Everyone's got their thing.
Ben, do you have any comments that stuck out to you?
Let's see. I actually do have one in mind. Let me go back to our last video because I know there were some there. But in the meantime, Ari, there's this question that I got from a viewer somewhat recently, and I'm going to paraphrase it, but they asked something to the extent of, like, do you ever feel like you're missing out on much greater returns by not investing in things like Palantir or SoFi? I thought for a while about that question because I think it's a great question. And put differently, in kind of generalizing it a bit more, I think the question that he's really asking is like, do you feel like dividend investing or investing with this long-term mindset, this, sustainable, slow and steady approach, do you think that like, do you ever feel like you're missing out when you see these other companies out there that are just like exploding? Do you, have you ever thought about changing your strategy to maybe look for more of those things? I thought it was a great question. What do you make of that?
Yeah, that's actually a pretty deep question, I think.
Yeah.
I think I never was envious of the positions that people invested into, but at one point I was envious of their returns. And I think there's a huge difference there because I don't want to be invested in the Palantirs, but of course I want the $1 million, right? And the other, over time, what happened for me was growth, like maturity and growth as an investor. You have to become comfortable with knowing that you are going to miss out on opportunities. If you have a process and a strategy in place that you are comfortable with, you are absolutely going to miss out on opportunities. And you have to go into this game of investing knowing that, because you can't pick them all. You don't have unlimited capital. So you're going to have to start to get selective. And in that selectivity, sure, like you might not see the Palantirs coming. The other question, comes down to if your whole game is, or deals in FOMO, the fear of missing out, maybe you shouldn't be an investor. And maybe that will set you back because you're going to be chasing, again, the quick get-rich-quick schemes or get-rich-quick stocks that are going to pull the rug on you. I'd be cautious of that.
Yeah.
What about you?
Dude, that's a great jumping off point. I completely agree. And when I think about companies like the Palantirs and SoFis, I truthfully don't know much about them. I really haven't spent much time with them, so I could be a little bit out to lunch on what I'm about to say. But at this point in the game, you're seeing those two in particular. They're very trendy stocks right now. You're seeing a lot of people start to talk about them, and it's kind of getting to the point with those where it's like, I could be in an Uber tomorrow and like someone will ask me about Palantir. And I mean, I'm kind of exaggerating, and that's kind of an old fable that's used to describe, or not fable, but that's kind of an old analogy that's used to describe, like if stocks get to that point, that's how you know it's in a bubble. But anyway, what I'm trying to get to is I feel that it's gotten to the point with those companies in particular, and it gets like that with all these companies that are maybe adjacent and like similar in nature, these hyper growth stocks that have really seen some like crazy positive momentum in a short amount of time. A lot of that is driven by, it's driven less by fundamentals. It's driven so much more by what Ari said, FOMO, fear of missing out, and like wanting to capitalize on the hype. It's seeing your friends or this creator or your neighbor making crazy gains with this one stock, and you want that for yourself too, so you jump in. And that creates a sort of a ripple effect where that happens with more and more people. More and more people start piling in, and then all that does, because there's more buyers, there's more demand. Supply doesn't change. There's more demand, so it's going to push the share price up. That's what kind of got lost there for a second. But yeah, that's going to push the share price up. More entrants, more momentum traders, more FOMO investors buying into it will increase the share price, which brings even more people into it until it reaches a point where it's not really sustainable any longer. We talked about this a couple of weeks ago, but it will reach a point where like there's only one way it can go, and that's down. And man, the ride is fun while it lasts for sure. But if you're going to like engage in that type of stuff, you really have to like, timing is a very important component to it. And that's like such an unpredictable thing to do. Like no one's got not a crystal ball. So it creates a lot of risk. And so for that reason, like I don't feel like I'm missing out when it comes to those companies or those types of companies. Just because it gets to a point where it's like, it's so far gone from its fundamentals, and that's no longer like what drives the share price. It's just these like proximal, these proximal factors that are impacting it. And I don't want to invest in that kind of stuff. Like that just doesn't really interest me. And kind of like you said, Ari, you have to be okay like missing out on some pretty substantial gains from time to time by foregoing those types of things. But ultimately, like from a long-term perspective, like I feel less stressed doing it. I'm still investing in really good companies. Like my portfolio is still growing just fine. And yeah, I don't know, chasing that kind of stuff it can be pretty dangerous, and you can get burned too if you base your entire strategy around that. And it works for some people. It's just not something I'm particularly interested in.
This came to mind as you were speaking. It's like we could say that about anything in life. Are you envious, or do you have FOMO that you didn't go into iBanking? It's like, not really. I don't want to work all hours of the day and night, and have zero sleep. And, I would rather be here on YouTube. And again, it just comes like, where are you holding? How are you thinking about things? And I think, I don't want to say it's like an immature mindset, but it kind of is. Like, you need to figure out, who you are, and go into life knowing that you can't grab onto everything. And so you got to enjoy this journey. And anytime emotions are involved in anything in life, let alone investing, I mean, it's a slippery slope. As you know, Ryne, from what is Richer, Wiser, Happier, all of those investors mentioned in that book had said that taking emotions out of investing is the smartest thing that you could do. And so FOMO is correlated to emotions. You gotta be unemotional about it. You can't be married to these stocks. I mean, could Coca-Cola ever come crashing down? Unlikely, but it could in fact happen. And so if you're married to Coca-Cola, buy, hold, and never sell until I die, well, you got to be careful with that, right? Like some of these, especially the Palantirs. And then you might find yourself, I don't know, in a really bad year, right? Like what happened with Bitcoin? Like everybody's all hyped up. Bitcoin is, I don't know where it is right now, maybe over 91,000. And it's amazing. I mean, it's crazy. It's amazing. Now I had for a bit of time the GBTC Bitcoin Trust, and I made money off of it actually when it first popped off, and then I sold it. And I was talking to someone else about this today, and I was like, well, if I didn't sell it, this thing only soared. But I was like, but it's not the stock for me. It's not a holding for me. And so I'd rather invest my capital in a company that I can sit with, understand, and enjoy, instead of just kind of this gambler's mentality and never wanting to miss out.
Yeah, man. And dude, you hit on something really important too there. Like the enjoyment of this for us is not so much in buying and selling the companies. It's the owning them. It's like being an owner of these businesses, these ones that we have, these affinities for. And that's where we derive like a lot of our enjoyment. And that's another reason why like I'm okay missing out on a lot of these things, because like for me to really benefit from them, someday I'm going to have to sell them. And man, I don't know. I think about the stocks in my portfolio, and it's like, man, I want to, and it's not always realistic, like we've talked about, to hold things forever, but I'd love to be able to. Like I really appreciate the companies that I own and what they do and how they do it. And yeah, it's just something I don't want to buy something just to let it go, especially if I enjoy it and appreciate it and it's like been rewarding for me. And I think that's one of the other cool things about dividend investing, is that like there is more than one way to benefit from the investment. There's another way. Like you can make money on it in share price appreciation, which is awesome. But there's another way. Like in the meantime, while you're an owner, you're still able to get that cash flow. You can get something out of that investment and benefit from that investment for potentially forever without having to let it go. And that's, at the end of the day, I think that's one of the biggest things that really keeps me like in this style of investing, because I think not just in my own lifetime, but I also think beyond that, like this is something, the things that I'm doing today and these assets that I'm building and collecting today, if I don't have to sell them, if I don't have to dwindle them down, if I don't have to let them go to be able to benefit from them, then that means like the people that come after me will be able to benefit from these too. My portfolio will not look the same today as it will 20 or 30 years from now. There's going to be different holdings, but like the underlying principles should be more or less the same, I think. And I don't know, I think that's one of the things that will always keep me investing the way that I do. And hopefully like the process gets more refined and I learn more and get smarter about what to look for in investments over time, and that will lead me to even better investments. But I think like tying it back to Buffett, like we were talking about earlier, it's just these timeless principles that will always be true. Just buy good companies that are growing and doing the right things by their customers and their shareholders, and just make sure they don't do anything crazy, and the rest kind of works itself out. They'll have good years, they'll have bad years, but if the principles that they follow, are on the straight and narrow and the financials reflect that, then it should work out over time.
I have one for you, another comment here.
Okay.
And it's actually, Scott, you mentioned, called out.
Okay.
But it's not in a bad way. Just says, I've watched Ryne a lot and came across your streams recently. And I don't know if he's referring to your channel, if you do this 100 share count goal. I know I do it, so it might be referring to mine. I don't know. It says, my question for you is, why stop investing after 100 shares and move on to something else? Won't you have FOMO on the dips? There we go again with the
Yeah.
FOMO. I this one makes a little bit more sense though with the FOMO. I know you could just drip and add more slowly while focusing on a new position while building up waste management and or UNH. I don't know why 100 shares is so important. So I guess I'll say, like, to add on to that and just make it a direct question, how do you know when to stop building out a position and move to another one?
I mean, it's such a good question. I mean, that one was directed at you. So what do you, clearly because the stocks it mentioned. So like, what do you think? Like, because I know you're not stopping at 100, but what do you think about that?
I think, what I meant to say when I share 100 shares, it was an arbitrary number. It was like, I'm going to build a strong foundation and I'm going to choose 100 because
it's just a nice even number.
Have a hefty number. Yeah. It's a nice round number there.
Yeah.
But I think that This is a really good question, actually. Like, how do you know when to stop building the position? Like, for example, right now I have 30 grand on the sidelines, just aside from the emergency savings, and I'm just this week I actually bought 2 more shares of United Health, and it popped today. When it popped, I was like, well, I should have bought 10, right? FOMO, right? I should have bought 10. But the reality is, I want to make sure that, like, every now and again, there are some major dips. Like Google, that has literally become one of my best investments when it dipped below $100 per share, and I went ahead to pick up like 10K worth, and then it soared. And so I know I want to have some firepower on the sidelines, just waiting for something like that, while still consistently dollar cost averaging into other positions. And then when I see some minor dips, buying 2-3 shares here and there. Wow, this is a hard question. I don't even know if I can adequately answer it. Like the number 100 is totally arbitrary. It's just something I shared to say build quality positions. Don't have like a holding
A share.
Of,
Don't.
Yeah, like a share, just so you can say you have it. Like build something. Mm-hmm. Man, I gotta pass it over to you, man. I might be stumped on this one.
Yeah, no problem, man. I think I've got a good take on. Well, you guys be the judge. But so here's how I approach it in my portfolio. I have this kind of general rule of thumb that I loosely follow. Okay, I don't always adhere to it 100%. But I try, when it comes to the individual positions I own, I try not to make one individual position larger than, say, 10-ish% of the overall portfolio. And, like I said, there's times, probably right now, I think with Starbucks and Visa, both of those are like 11-ish%, so they're over that. I still feel totally fine with that. But, I think one way you can approach it is by setting those sort of guardrails for yourself to not go way too heavy into one position. And also, like Ari said, on the other end of that, you don't want to just buy a share of a company just to say you have a share of it. Like, if you're going to buy a company, you should strive to build a meaningful position into it, and you'll have to determine like what that looks like for you. Now, for me, I know when to stop buying a company. I know I have enough shares when, I guess, 2 things happen. I mean, that number one, like I said, when it reaches X% of my portfolio at first, I'm like, yeah, I should probably hit the pause button before it gets too out of hand. But then on the other side of that, and it becomes kind of a balancing act. And it's kind of a tough judgment call to make, because on the other side of that, I'll give you a concrete example too in just a moment. What if the stock's still at a good valuation and it's a great buying opportunity still, and it's reached 10% of your portfolio? Yeah, it's tough, because now you're playing with these 2 sides here. And so how do you know which one's the right decision? Now, in my case, I'm going through it right now actually with Johnson & Johnson. I've gone through it a few times with Johnson & Johnson. Right now, J&J is below my cost basis, and it's about 9% of my portfolio, so it's kind of on the upper end there. But I'm looking at it thinking, be that as it may, it's a good time to buy J&J, so I should take advantage of this. I know Ari's going to feel differently about that one now, but yeah, I should take advantage of this opportunity. Imply this to any stock. This is just one concrete example for my portfolio. But I should take advantage of this buying opportunity. So pretty soon I might start buying some more J&J because it's a good valuation. And that's not always going to be true. Like with Starbucks, that's another good example. There was a period where it dipped down, and it was already one of my largest holdings, but it dipped down to like, under $80 a share, like mid 70s, even low 70s. And I'm like, heck yeah, I'll swoop up some shares when it's there. Like, the opportunities to do so tend to be pretty few and far between. So while it's here, I might as well buy it, even though it's already my largest position. And I do so with the mindset thinking at some point, like, I won't be buying this. Realty income, that's another one. This happens from time to time. It fluctuates between, the low 50s and the 40s, then it'll get up to the mid 60s, maybe even upper 60s. And you have to take advantage of those buying opportunities when they present themselves. And I think in those moments, it's okay to go a little bit outside of your comfort zone, make it a little bit heavier of a weighting in your portfolio if need be, knowing that the day will come to pass when it's no longer a good buying opportunity. Or there will be a point, let me rephrase that. There will be a point where it's no longer a good buying opportunity. So you have to take advantage of it while it's there. And then, while that one becomes a bad buying opportunity, there's going to be something else you're buying. And over time, that should result in a decently well-balanced portfolio to where things don't get too out of whack. You know what I'm saying? So that's kind of how I go about it. It's balancing the percent allocation in my portfolio with what's a good buying opportunity. And if something is a good buying opportunity, like I will put more emphasis on that than I will it being 10% of the portfolio. Because I know at some point, like I'll start buying something else and this will become, the weighting will come back down and it'll even out. Like there was a point, just to close the book on this, there was a point where realty income was like 15 or 16% of my total portfolio because I was just buying it left and right, which was a good move because it really lowered my average cost per share from being above $60 per share to like the mid 50s. Now it's getting into the low 50s, like 54-ish. And so that was a good move. And it was worth it making it that heavy in my portfolio for the time being. But now it's come back down. It's like 8 or 9%. So it works out.
It's interesting because, I have a portfolio pulled up in front of me. And so I like everything that you shared. But the reason, on my end, I'm like, I don't know how to answer this really because I'm even looking at this portfolio. It's got 26 and I don't know if this is the correct stats as of this video. So when I reveal whose portfolio it is, everyone relax. Right? It's got 26.24% worth of one holding. And then it jumps down to 15.44% of another, 11.88, 10.79%, 4.94%. And those positions are Apple, American Express, Bank of America, Coca-Cola, Chevron. Whose portfolio am I talking about?
Oh, I can only imagine.
Mr. Warren the Buffett Snowball, right? Like, this guy's loaded up on Apple at 26%. And so I kind of think, like, I would love to say, like, yeah, it's good to have the, equal weight. But then I look at some of these Wall Street hawks, just these, like, legends, and they're super concentrated in certain positions. So I think that just made me think, like, and I just had another, master of them. It was earlier this week, a guest on this guy, John Lowe, and he used to work on Wall Street for 3 decades. And he was like, isn't it always funny that people on Wall Street tell you to do X and they do Y? And like a lot of these people are like, yeah, have a very well-balanced portfolio, diversification. And then we see them breaking the rules. And then I think to myself, like, why is it? Even Buffett himself, 26+% worth of Apple in that portfolio of his. And I just look at my portfolio then, and I kind of just run with this notion of, like, what stock do I have the most conviction on? I'm going to pour my heart and soul and hard-earned money into that position. It's a bit of a risk for sure. Not everybody should be doing this if you can not tolerate that volatility. But on the other end, again, if you're doing your due diligence, if you have high conviction based off your due diligence, you could put the money in there and feel pretty comfortable. Like someone commented on this or said this to me, I think like the other day or whatever. I read the comment, and it was like, I can imagine Ari one day is going to have like a foundation of 2 ETFs and just 4 holdings. And I was like, maybe. Yeah. Like, I wouldn't put it past me. I already trimmed down to this, 7 to 10 goal. And now I'm like, the guy I had on, John Lowe, he was like, some investors just jump on here and go all in on one stock. That's it. Yeah. I just last week I sat with someone and he was asking me about inheritance tax because his grandfather, this is absurd. His grandfather, when Apple first came out, poured money into Apple and didn't know what Apple was, didn't know anything about anything, and just knew he had to invest. So he threw some money into this company called Apple. And now this guy has inheritance of over $1.5 million. He's 19 years old.
Oh, my gosh.
Think about that. But, like, this guy, just a single stock portfolio. Now, I couldn't do that. Yeah. That's a little too risky for me, but I'm all for the concentration.
Yeah, that's a great addition too, man. Like that certainly plays a role as well, how many holdings you have and how confident you are in those holdings. Obviously, the less number of holdings you have, the more that each one can make up in your portfolio. And the inverse of that is true. And so that for sure plays a role. And I think you'll naturally come to find this kind of gets into diversification and like how many stocks should you own. And I think you'll naturally come to find like what that sweet spot is for you over time. For Ari, it could be like 2 foundational ETFs in 4 individual stocks, which actually like the ETFs create that create the diversification. So you don't need, a whole lot of holdings. But you also might be someone who doesn't have ETFs and has just like 20 individual stocks. And believe it or not, like that's actually still pretty decently diversified too. If you have deeply researched all of these and have conviction in them, then that's also not like a bad sized portfolio. And there's some people too who, get upwards of 40, 50, 60 stocks. So you'll naturally come to find like where you fall in all of that with time. So,
and Jimmy from Learn to Invest, are you familiar with his channel?
Yeah, and I think you guys had a really good conversation.
So he was on, and one of the reasons I wanted to pull him on was actually because he had a portfolio of 7 to 10 holdings. Like he talks about this really small portfolio. Now, he was also an analyst on Wall Street, knows Wall Street inside and out. And I just thought it was interesting. Like, here's a guy, again, worked on Wall Street. Now he's a YouTuber. Just looking to do the same thing that we're doing, Ryne, helping investors out. And he's crafted this portfolio of just about a dozen holdings less. It's very interesting to me. We seem to go through these, like, I don't know, the investor path, right? Like everyone starts off like, I'm super excited, right? Got to get into everything. And then we quickly find it's like, okay, receiving a 10-cent dividend every other month or whatever is not so fun. So let me focus a little bit more and get my bearings right. And we all seem to go down this trajectory and come to find ourselves, which I think is beautiful.
Yeah, absolutely, man. It is the way of the investor for sure. And that's the fun of it, like to kind of close the book on all of this stuff and I guess kind of wrap it up. Been going for almost an hour and a half. This has been a good one. I don't know. That's just what makes it so fun. Just to see how, and I've only been doing this for coming up on 5 years here pretty soon. Not a long time in the grand scheme of things. Like that's a drop in the bucket for investing timeline. But man, it's cool to look back and just think about how far you've come and how much you've learned along the way. And that's what it's all about. And that's part of what makes, especially investing in individual companies, like that's part of what makes it worth it. So I'll leave it there.
Investors, I want to say, I guess 2 things. One, let Ryne and I know some of your biggest lessons learned over your course of investing down there in the comments. Some of your biggest mistakes, if you will, but the biggest lessons learned, really. And then on top of that, throw some questions in there. Like,
yes,
be real with us. What questions do you have? Even if you think they're silly, throw them out there. There's no question that should go unanswered. We'll try to get to them. Pop more questions here on the chat, whatever we want to call this. But,
absolutely, guys.
We really owe everything to you guys.
Absolutely. Any questions you guys have, no matter what it is, drop them in the comments. At the end of the day, like we're here to help, and we love answering. We love being able to do this and talk with each other, and we love being able to have you guys like be included in that. In a way, it kind of feels like you guys are all right here with us too. And so yeah, we'd love to hear from you guys. We're here to help. That's why we do this, and so we would love to take whatever questions we can from you guys. So, and we're doing this weekly, so we'll see you guys Thursday today when this will go out. And hope you guys enjoyed this one, and we'll see you back next week.
Until next week, investors.